If you're planning to leave your super to your kids, there's something the ATO would rather you didn't notice. Australia scrapped inheritance tax decades ago. But there's a quiet death tax still living inside your superannuation. And it only fires when your adult children inherit. It can take up to 17% of the money you spent a lifetime building. Millions of Australians will eventually leave super to financially independent adult children. And most have never heard of this hidden hit. Today, I'll show you 3 timing moves that can take that tax bill from 6 figures down towards 0. We'll map your exposure, convert taxable money to tax-free, and time your withdrawals after 60. Here's the number that should make you sit up: 17%. That's 15% tax, plus a 2% Medicare levy on the taxable component of a super death benefit paid to non-dependents, like adult kids who work for a living. Under ATO rules summarised by ASIC's Money Smart in 2024. But here's the part nobody tells you. It's not a tax on how rich you are. It's a tax on timing. 3 moves and you can start each one today. Map your hidden death tax exposure, run a recontribution strategy, and time your tax-free withdrawals after 60. Each takes under 30 minutes and all the tools are free. So how does this actually work? When you die, your super is split into a taxable component and a tax-free component. Death benefit dependents, your spouse, kids under 18, certain financial dependents receive both parts completely tax-free. But a non-dependent adult child pays 15% plus 2% Medicare on the taxable portion, according to ATO rules, via ASIC Money Smart. Same money, same fund. The only thing that changed is who inherits it. Look at how stark that is. If your spouse inherits, the rate is 0. If your working adult child inherits the very same balance, it's 17% on the taxable component, according to ATO rules via Money Smart in 2024. On a $700,000 balance that's roughly 85% taxable, that's around $101,000 gone. Your child receives about $599,000 instead of the full $700. Prime Financial, 2024. There's a second layer that makes it worse. Most Australian super is 80 to 100% taxable component because employer contributions and salary sacrifice go in pre-tax and are taxed on the way in. And from around the 1st of July 2025 or 2026, Division 296 adds a new 15% tax on earnings for balances over $3 million. Hayton Koski, 2024. So you can be taxed extra while alive, then your kids taxed again at death. Put the 2 paths side by side. Do nothing. Leave the full $700,000 inside super, and your adult children cop around $101,000 in death tax on the taxable component. Prime Financial, 2024. Plan the timing instead, and you can convert taxable money to tax-free and draw it down after 60, pushing that death tax towards 0. The difference is real money your family keeps. Here's the belief that stops people acting. There is no death tax in Australia, and for a general estate, that's technically true. But it's dangerously misleading for super because the ATO taxes the taxable component left to non-dependent adult children at up to 17%. Believing the myth is exactly how families lose tens of thousands. Let's see the combined damage. On a $700,000 balance, the death tax is around $101,000, Prime Financial 2024. On a $3.5 million balance, it's about $476,000 on the taxable component before Division 296 even applies. Hayton Koski, 2024. For high balance Australians, poor timing turns into a 6 or even 7-figure lifetime tax cost. Meet Greg. He's 62. A self-employed electrician earning $110,000 a year with $900,000 in a large retail super fund. He's got a wife with no income and 2 working adult children aged 30 and 33. He plans to stop full-time work at 67. Here's what Greg found when he read the fine print. Greg's first discovery hit hard. About 85% of his super, $765,000, is taxable component. If he dies with everything still in super and it goes to his adult kids, that's a 17% hit. $130,050 gone. Prime Financial 2024. His kids would get about $770,000 instead of $900,000, even though he already paid tax on the way in. His second discovery was the way out. Greg can withdraw $300,000 from the taxable component and recontribute it as a non-concessional contribution, which turns it into tax-free component within his caps, ATO caps, via Prime Financial 2024. That drops his taxable component to $465,000 and cuts the death tax from $130,000 to $79,000, saving his family about $51,000 from a single planned move. The third discovery was the simplest of all. Because Greg is over 60 and draws from a taxed fund, his withdrawals are generally tax-free in his hands, according to ASIC Money Smart. If he draws $40,000 a year for 10 years, that's $400,000 pulled out of the taxable component, money that would otherwise have faced $68,000 of death tax. Money Smart 2024. Just by timing his withdrawals, it's gone. Add Greg's two strategies together. Do nothing and his family pays $130,000 in death tax. Recontribute $300,000 and draw $40,000 a year for 10 years, and the taxable component at death is around $65,000. A death tax of just $11,000. That's a family tax saving of about $119,000 purely from timing modelled on ATO rates. So could this be you? Sign 1. You've never checked how much of your super is taxable versus tax-free component. Sign 2. You plan to leave super to financially independent adult children. Sign 3. You've turned 60 but haven't withdrawn or recontributed a cent. If any of those apply, the 17% is sitting in your super right now, waiting. 3 moves. Let's do them. Each one is free and takes under 30 minutes. Start with the first move today. It only takes a few minutes and the rest follow from there. Move 1. Map your hidden death tax exposure. Log into your super funds online portal or grab your latest statement and find the breakdown between taxable component and tax-free component. Then multiply the taxable amount by 17% for anything heading to your adult children. That single number is your current exposure, and most people have never once looked at it. This is general information, it's not personal advice. Here's how. First, record your total balance and the dollar amount that's taxable component. Second, list your beneficiaries and classify them as dependents or non-dependents using the Money Smart definitions. Third, multiply the non-dependent portion by 17%. Good looks like most of that money sitting in the tax-free component. Move 2. Run a recontribution strategy. Once you've met a condition of release, you withdraw a lump sum from the taxable component and recontribute it as a non-concessional after-tax contribution. That washes taxable money into tax-free, which adult children always receive completely tax-free. Check your non-concessional cap and your total super balance first on ATO Online. Here's how. First, confirm your non-concessional cap. Currently $120,000, rising to $130,000 from July 2026. And your bring forward eligibility. Second, withdraw a lump sum from the taxable component. Third, recontribute it within your cap. Good looks like a bigger tax-free component on your next statement. Move 3. Time your tax-free withdrawals after 60. Because withdrawals from a taxed fund after 60 are generally tax-free in your hands, you can draw down taxable component for living costs, gifting, or investing outside super. Every dollar you pull out is a dollar that no longer sits in super at death, so it can't be hit with the 17%. Here's how. First, confirm you're 60 or over and your fund is a taxed fund. Second, set up a regular pension or lump sum drawdown from the taxable component. Third, spend, gift, or invest those amounts outside super. Good looks like your taxable component shrinking every single year. Why act now? In 2024, the ATO's 17% death tax on super was restated through Money Smart, so there's no ambiguity left. From the 2025-26 year, Division 296 brings a new 15% tax on earnings for balances over $3 million. Hayton-Koski, 2024. And from the 1st of July 2026, the non-concessional cap rises to $130,000. The longer you wait, the bigger your taxable component grows, and the more the ATO collects. After you act, check it actually worked. You should see a larger tax-free component on your next super statement. Confirm your recontribution stayed within your non-concessional cap so you don't trigger excess contribution penalties. And if your taxable component is falling each year, your timing strategy is doing its job. Everything today comes from ASIC Money Smart, ATO rules, and specialist estate planning analysis from firms like Prime Financial and Hayton Koski. All the links are in the description below so you can check the figures yourself. So now you know, map your component, recontribute to wash it tax-free, and draw down after 60. Next time, I'll walk through exactly how a recontribution strategy works, step by step. If this saved your family even $1 of that 17%, subscribe. Because we read the fine print so the ATO can't quietly keep your kids' inheritance.